ladies and gentlemen. Welcome to our morning briefing, Transfer Pricing Series. I'm Jelita Anggraini, Transfer Pricing Assistant Manager of SF Consulting. It is my honor to be a moderator for this seminar. First of all, may I briefly introduce you to our guest speaker, Mrs. Soumya Varadarajan from Crow, Singapore. She is the Transfer Pricing Director and Leader. Soumya started her career in transfer pricing at PwC, having worked as part of the transfer pricing practices in both of the US and Singapore. Soumya has extensive experience in preparing transfer pricing documentation and defending such documentation before tax authorities, either as part of the transfer pricing audit process or through the advanced pricing agreement process. Soumya has advised on a wide variety of issues, ranging from simple transfer of goods between related enterprises to more complicated arrangements of buy-in, co-share, cost-contribution, and intellectual property transfers. In terms of industry experience, Soumya has extensive experience in the high-tech or semiconductor, as well as pharmaceutical and biomedical industries. In addition to her transfer pricing expertise, Soumya also has considerable experience on tax and intellectual property valuation projects. Our second speaker is Gandhi Herman Siregar. He is our transfer pricing manager here in SF Consulting, Crow, Indonesia. Gandhi Siregar is a chartered accountant and member of Indonesian Accounting Association. Prior to joining SF Consulting, he was the head of transfer pricing for Gojek Indonesia since January 2019. He helped in building the transfer pricing structure of Gojek Group in Southeast Asia. Previously, he worked as transfer pricing consultant at PwC Indonesia and advised Indonesian and foreign multinational groups on transfer pricing matters, tax litigation, and other business transaction matters. He attended University of Advent Indonesia in Bandung and has a bachelor degree in accounting. I would also welcome our partners who also join us today. Our managing partner, Ibu Sri Wahyuni Sujono, our senior partner, Bapak Stan Pranoto, and our partner, Ibu Ratna Febrina. Before we begin, I would like to remind you once again to fill the attendance list by typing your name and company in the chat box. There will be 30 minutes of Q&A session. However, if you have questions during the presentation, you are welcome to fill it in the chat box. We will read the question and answer it during Q&A session. Please type the question and for whom the question is addressed. At the end of all session, we will need you to fill the client feedback form. The link will be sent to you shortly after the session is ended. Today's presentation material and e-certification will be provided for those who have filled the client feedback form. Now, let's begin our morning briefing. The first presentation will be presented by Mrs. Soumya. Soumya, the time is yours.
Thank you, Jelita. I'm going to share my screen first. Can you help me share my screen, Jelita?
Okay, no problem.
Yeah, thank you. It says host has disabled screen sharing.
Okay.
Yeah. Okay, so while we get that sorted out, I thought maybe I can just give you a little bit of an agenda as to what we're going to be covering off today. Essentially, the topic that has been assigned to me is transfer pricing in the new normal. And as you all know, we are currently in the new normal with COVID-19 and all of the changes in the regulation that is taking place. And in general, my focus is definitely not going to be from an Indonesian standpoint. I will leave that to Gandhi, but my focus is actually from global first, so we understand what are some of the global changes that are taking place, and then we bring it down to the Asia Pacific region, because most of you, while you might be focused on your Indonesian operations, you might also have to understand what's happening, for example, in Singapore, what's happening, for example, in Australia or Malaysia, so on and so forth. So my scope, at least from an overall perspective, is to talk about a regional focus on transfer pricing more than an Indonesian focus. Okay, let me try and share my screen now. Do you all see the slides? Yes, I presume so, because I'm not hearing anything else. So let's get started, okay? So transfer pricing in the new normal. What is it that we're going to cover off today? The first thing we will talk about is recent transfer pricing developments, and we will then go into the impact of COVID-19 and how it has impacted transfer pricing. I think many of us will be considering, as a result of COVID-19, should you be changing your transfer prices? What are some of the things that you might want to do differently? That would be the second topic that I'll cover off. And the third topic that I'm going to be looking at is what are some of the changes in the business model that are likely to come about as a result of this new normal, right? So the changes in the business model can either take place from a technology perspective. I mean, who knew that we were now going to be in this world of Gojek and Uber and ride share, as well as delivery, and now you can order anything that you want, and that has been very helpful during the COVID-19 period. But if you think back, say 5 years ago, right, is this what one would have foreseen, right? And if it is not, then what are some of the changes that you can contemplate on a going forward basis? I think the other big development from a technology standpoint is also going to be the whole rollout of the 5G network. And there is a lot of discussion, and even though we have awaited the 5G for quite a while, because of the focus by Huawei on as a potential service provider, there are discussions, particularly in the US and the UK, around whether this is the way we want to go. Do we want to use an alternative service provider? And because of that, 5G transformation itself is getting delayed slightly. But these are some of the things that you might also want to keep in mind, to understand how you should be operating in the new normal. And at this point, I would like to state that if you think about it from a tax authority perspective, even though we as taxpayers you guys as taxpayers and us as consultants supporting you as a taxpayer, we are starting to think about these sort of issues, right? However, when you go into the tax return forms or the submissions that you do, so even in Indonesia, right, when you're picked up for a transfer pricing audit, they ask you, what is your business categorization? So you've got, are you a service provider? Are you a distributor? Are you a manufacturer? The categorization that exists is actually quite simplistic and is not reflective of this new business model that we are all working towards, right? So the entire thing on digital is not included. So many times, and one of the things that you all might be aware of is also the country by country reporting, right? The CBCR. Now, when you look at the CBCR, again, what they ask you is, are you an R&D center, procurement, sales and marketing company, administrative services? They don't talk about the more complicated structures. For example, if you are Yahoo or you're Google, right? What are you going to be categorized as? You're not a service provider. You're not a distributor, You are something unique and new, right? Same thing with Uber or Gojek or any one of them, right? You're not in the business of buying and selling goods. You are basically an intermediary that ensures and makes it easy for people to have access to products, right? So in this case, what is it, when are we going to start seeing the tax authorities and the OECD also change, right, some of the characterizations to keep up with the new business models that we're coming up with? I think that is a very, very interesting question as well. Okay, so in terms, let's get started on the recent transfer pricing developments first, and essentially what we will start off with. Sorry, give me a second. Yes. Okay, so essentially what we're going to start off with, what are some of the transfer pricing trends that we saw and we left off from in 2019, right? And I think let's go across this list, right? And I've said that this is pre-COVID-19 because as a result of COVID-19, there's going to be a new set of transfer pricing trends as well. But this is all pre-COVID-19. So what are some of the things that we noticed, in the industry? I think the first one is the international tax and transfer pricing environment is highly, highly uncertain. And it is extremely difficult for taxpayers to foresee the range of questions that a tax authority is actually going to be asking. And this is not just in Indonesia. I have clients who are going through audit processes in Indonesia where, to be frank, there is an increased sophistication of the tax authority in Indonesia, but it's the same across the other markets as well. Whether you look at Singapore, whether you look at Malaysia, that, tax authorities are starting to learn with all of the information that is being shared from the OECD with respect to how they want to look at transfer pricing related party transactions. So I think that's the first one. And the positions that we were taking previously may not necessarily hold true on a going forward basis either. Okay, so that's the first one I wanted to talk about. Let's look at the second one, and I'm going to go around this in an anti-clockwise direction or a clockwise direction. The next one is, irrespective of the need for transfer pricing documentation, right, taxpayers need to be able to demonstrate that transactions are arm's length. Okay, and so this is something that we're noticing in jurisdictions like Myanmar. Myanmar actually doesn't have transfer pricing legislation yet, and they are in the process of, a draft exists, but it has not even been shared with the public for public consultation yet. Having said that, tax authorities in Myanmar are also focused on transfer pricing. They just see it as low-hanging fruit. So even though you may not necessarily have transfer pricing documentation, you are still required to be able to show that your transactions are arm's length. So this again creates a level of uncertainty for taxpayers that are operating in jurisdictions that does not have a robust transfer pricing regime. And there are not that many of those either. Okay, so an example would be Philippines. Philippines does not have, has not implemented Action Plan 13 yet. The original transfer pricing guidelines that requires transfer pricing documentation was probably put out there maybe in 2013, 14, right? So it's been quite a while. They keep talking about updating those guidelines and making it consistent with OECD, but that hasn't happened yet. The tax authorities have introduced transfer pricing audit guidelines in the Philippines, which is kind of strange, right? So if you do not have a robust transfer pricing documentation regime, on what basis are you going to start doing transfer pricing audits, right? So that again says that irrespective of whether you have transfer pricing documentation or not, you would still be required to be able to show that your transactions are arm's length, right? Now, if you look at a country like Singapore, we have a very, very unique documentation rules process, right? So we have to check multiple things if we want to figure out whether we meet the requirements to prepare transfer pricing documentation or not. So if there are certain transactions where they do not meet the thresholds, and therefore you do not need to prepare transfer pricing documentation, the IRAS in Singapore still comes along and asks questions, and they want to confirm that the transaction is still arm's length. Okay, so that's point number 2. Point number 3, right? There is increased information sharing among tax authorities. And this largely has come about because of the exchange of the country-by-country reports. I mean, in Indonesia, country-by-country report preparation regime started with PMK 213 that introduced the 3-tier documentation approach, right? And so essentially, taxpayers are required to submit their CBCR with the Indonesian tax office. And there has been an initiative by OECD to collect all of this CBCR, and they have gotten a database together where they are trying to check and see whether we introduced all of these changes in our international tax law. Has it actually gotten fruition? Okay. In addition to this, okay, one of the things that we are noticing, particularly during the COVID-19 period, is that when OECD decides to use, or when they want to do some sharing sessions and so on and so forth, because now with COVID-19, the nobody can actually fly. Right? So everybody is staying in their own locations, and all they have to do is, like we are doing, zoom in into Zoom, right? And so from a tax authority revenue perspective, it is actually a very, very cheap alternative than having to fly all the way to Paris, okay, to have a discussion with the OECD. So we are seeing that, on a monthly basis, when OECD asks for these engagement processes with the other revenue authorities, more and more people are getting involved. And as a result of that, there is again more sharing, right? So this is informal sharing as well. I think the other big trend is that increasingly taxpayers, particularly ones that have more defined transfer pricing teams or tax teams, are starting to realize that there needs to be centralized and consistent control on transfer pricing in terms of documentation, in terms of providing input to the tax authorities, for 2 reasons, right? Number 1, the same consistent story is being shared, because what is often happening is there's also been an increase in dispute resolution as well, right? So if you were then to go and meet with the tax office and share with them your transfer pricing documentation, you want to make sure that this has been prepared in a consistent manner between the 2 jurisdictions, right? So rather than having each and every local entity take on their own initiatives as far as transfer pricing documentation is concerned, there tends to be a more centralized and streamlined approach to transfer pricing documentation. That is something that we have started seeing. Okay, and that essentially stems from the need to prepare the master file at the group level, and then based on that, you're supposed to create these local files. At the same time, we are also starting to see that even though they might let the local entities bear the cost associated with transfer pricing documentation, and they want the local entities to be empowered with the need to prepare transfer pricing documentation, central or the group headquarters is basically reviewing all of these TP reports to make sure that it is consistent with what is being, that the story is actually being consistent. Okay, that's another thing that we are starting to see. The other thing is that, increasingly the taxpayers are also starting to say, can we start working with the regional teams, right, and make sure that the TP reports are prepared in a consistent manner. Okay, definitely we are seeing an increase in transfer pricing audits, and with COVID-19 as well, I think this is only going to go up. And I was actually at a seminar yesterday, and there was somebody from Indonesia that was presenting. And, as you all know, if you have a refund or an overpayment situation in Indonesia, if you were to go and ask the tax office for a refund, that typically ends up leading to an audit. And one of the questions that the taxpayers, the audience was asking was, because of COVID-19, there is going to be a likelihood of a significant, more number of people are going to be in an overpayment situation. Is this likely to lead to more audits? And the guy was actually saying, yes, it's true, right? Because if I have to give you back the refund, I have to audit you first. In terms of the areas of controversy that we are seeing, most of it tends to be in relation thus far It's been in relation to goods and services, so the most simpler transactions. We're also seeing quite a number of intragroup financial services transactions being looked at. And one of the questions that keeps coming back time and time again is whether the borrower really needed to borrow the money or not. Or did the funding company or the lender basically decide to lend the money in order to take a deduction at a lower tax, at a higher tax rate, right? So that's one thing. Going forward, okay, the view is that intellectual property considerations is actually going to become really important. And a lot of tax authorities are very closely following on a couple of key topics on IP, right? Number one, if you pay a royalty for technical know-how and you pay it for, say, 20 years, right? The question that they ask is, you know, as a company that's been using this, have you not learned anything at all? Are you so, you know, I'm going to say incompetent, which is not a very good word, and have you not learned anything at all, okay, by using all of this IP, that you need to have this intellectual property being licensed to you year on year, right? I think that's the first thing. With respect to marketing intangibles, the question is that, are you not able to convert these, you know, win over new customers on your own? Do you consistently need support from the overseas entity? And I think the focus there, okay, from a review perspective, should be on the additional work that is being done by the foreign jurisdiction to enhance the intellectual property, right? I am not sure how many of you are aware of the term called DEMPI, right? So with in the intellectual property section of the OECD guidelines, you've got to have you know, you've got to identify who is doing the development, enhancement, maintenance, protection, and exploitation activities, right? So just because you develop it doesn't mean that your duty is over as an IP developer, right? In most cases, you will develop it and then you take it to the next step to enhance it, to maintain it, create the next generation intellectual property, which will rely on the first generation intellectual property. So there's a lot of work that is being done, right? As a taxpayer, what you need to do is to make sure that the tax office understands that a product that you are selling, that you're manufacturing and selling, is not stagnant. And I don't understand, again, right, going back to that new business model perspective, I don't understand why any tax authority will assume that this is basically standard, right? And it's not. And all of the R&D is actually being done in a foreign jurisdiction, and that royalty that, you know, that is being charged is in relation to the R&D investment that the foreign jurisdiction is undertaking. The general view from the business community is that intellectual property is going to become one of the hottest topics in this situation, right? And you know, I do have some slides in here on IP as well, which we can come back to from a COVID situation. The next one is that you know, despite the need for contemporaneous documentation, and you all know what contemporaneous is. It is basically annual transfer pricing documentation. Many taxpayers do not have transfer pricing documentation prepared, right? And this is not just in you know, the less sophisticated jurisdictions. It's not Vietnam or Thailand that we're talking about. This is actually even in countries like Singapore and Australia, where there is a very defined, robust regime of transfer pricing analysis and reviews. But yet, there are many taxpayers that are taking I'm going to say a laissez-faire approach. That's basically to say that, well, I'll wait and see when the tax office comes, but without realizing that the penalty at that point of time can actually be substantial. Okay, cost considerations is a big one for transfer pricing as well, and a lot of that has come about because of BEPS. BEPS Action Plan 13 has brought in the implementation of Local File Master File CBCR, which means that companies that are operating in multiple jurisdictions have to prepare transfer pricing reports for each and every of those jurisdictions, right? Because in most cases, you know, in Indonesia, if you look at it, I think your thresholds are quite good. But there are countries that don't actually have thresholds, right? Like the Philippines. right? Or Cambodia. Cambodia actually has transfer pricing rules, and they don't have any thresholds, that even if it's a $1 transaction, you would have to do transfer pricing documentation. I think the other one is the constant discussion on permanent establishment, right? With respect to transfer pricing, that has definitely gone up in recent times, and it's something that tax authorities are actually focusing on. Okay. I just wanted to give you a very, very high level view as to where we are from a transfer pricing trends perspective. But let's move on and see what are some of the OECD related changes that have taken place, and how are they going to impact you in Indonesia, or if you have regional responsibilities, how will they impact in the rest of the region? I think the first one is there is a view that the definition of arm's length has actually changed. And this is not like explicit in the OECD transfer pricing guidelines, but it's more hidden. It's you got to read between the lines. But two jurisdictions that have actually implemented it, one is actually Singapore, the other one is actually Australia, right? And this basically gives the tax authorities the ability and power to reconstruct transactions where they do not meet the following tests, right? So the first one is where the form of the transaction, right, is different from the substance of the transaction. So the substance might say that if you actually look at it, it seems like you are the IP owner, okay? Yet, when you look at the form of the transaction, it may seem like you are just a contract R&D service provider, right? Now, if the tax office comes along and looks at the transaction, and based on the function, asset, and risk profile, they review the transaction and they say that in substance, you're actually an IP owner, they will disregard, right, that income that you received in relation to your contract R&D activities and substitute an alternative pricing structure. Right? So that's the first test that you have to show. The second test that you have to show is where independent entities in comparable circumstances, they would have entered into a different set of transactions. So the transaction still takes place, but the pricing associated with the transaction, or the way in which the transaction takes place, is slightly different. Right? So let's look at an example for this. Okay, so the easiest one is you have a company that is borrowing money from a related party. Interest rate, let's assume, is 10%. After 3 years, the local market interest rate goes down to 3%, right? So what would a third party do? A third party would basically borrow locally and repay that 10% related party loan, right? So if the taxpayer does not do that, right, then basically what the tax authority can do is they will disregard that transaction of the 10% interest rate, and they will substitute it with the 3% interest rate, because they will argue that a third party would have actually not continued to service a higher interest rate loan. Okay. The third thing is that if you can show that, or if the tax office can show that an independent party would not have entered into this transaction at all, so the transaction should not even have taken place. Okay, let me give you an example, right? So you have, let's assume that Indonesia wants to lend money to Singapore, and the Singapore interest rates are at, if I was to go and borrow money, it would be about 2, 3, 4%. Let's assume that Indonesia wants to lend me money for a US dollar loan. They want to charge me 10%, right? And I, as a related party, enter into this loan transaction. The IRAS will come along and say, actually, no third party would have actually entered into this transaction, because the interest rate that is being offered to me is way higher than what I would have been able to borrow locally. So in this case, they will disregard the entire transaction, right? So the first thing that, as part of all the changes that's been happening is the enhanced definition of arm's length. I know that, for example, in Indonesia, and obviously Gandhi and Jelita can clarify this further when they talk. I don't think Indonesia has actually specifically picked up on this and modified its transfer pricing guidelines to reflect all of this. But having said that, in general, the Indonesian transfer pricing rules are also, they make reference back to OECD. right? And I have been in situations where my clients have told me that they have gone to audits and the tax officer comes there with the OECD transfer pricing guidelines and he's quoting from it, right? So if that is the way that that's the way the Indonesian tax office is going to operate, then, you know, just because they have not put in a specific provision in their guidelines does not necessarily mean that they will not make the argument, right? Because they might say that I've already referred back to the OECD and I say that I adopt the OECD transfer pricing guidelines. So if there are changes there, those changes will automatically flow through here as well. Okay. The next one that OECD introduced recently is actually the intragroup financing paper. This was finally finalized, okay, in February of this year. This is actually, we were waiting for this for a long time. If you are all aware of the BEPS related updates, the BEPS action plans were all finalized back in 2016. So this is actually really, really late. But, you know, having said that, it's better late than never, right? So we're glad for this guidance that they have provided. It basically consists of 3 broad sections. So the first section is on accurate delineation of the transaction. So essentially the question is, again, going back to the expanded definition of arm's length. So it gives the tax authorities the power to you know, reconstruct the transactions if the 3 conditions that we talked about earlier are not met. And I think the second one is it raises the fundamental question as to whether a transaction is considered to be debt or whether it's considered to be equity, right? The next section of the guidelines really focuses on specific transactions in the intercompany financial space. So essentially it talks about, you know, treasury functions, you know, what sort of activities should a company be undertaking if it is a treasury company. How should it be compensated? Should it be compensated by way of a service fee, or should it be compensated by way of an interest rate margin? And what are the parameters that one needs to keep in mind and consider to determine, you know, which way we should go? Also provided guidance on intra-group loans, where essentially they have said that you really need to make sure that you have a credit rating done on the borrower. It has given guidance on how the credit rating is done, and then, you know, determine what the interest rate should be. It has also come up with other methodologies that could actually be used. But the one thing that they have very categorically said is that bank opinions should not be used as a comparable transaction. So if you go and ask the bank, hey bank, how much will you lend money to me? And the bank says, I will lend you $200 million at 3%. You cannot say that therefore my arm's length interest rate is actually 3%, because that's what the bank is going to lend me, right? At the end of the day, when you actually sign the contract with the bank, there'll be so many other things that may actually come in. Cash pool structures, I don't know how common they are in Indonesia, but essentially you've got, you know, it's possible that you might have a physical or a notional pool where you have entities, right, that are either lending, that are cash rich, that they lend to other companies in the group. But it is not one-on-one intra-group loans, right? Rather, they provide everything into a treasury function, and then the treasury function is the one that, you know, manages all of this. So that's one thing. Hedging, particularly with respect to foreign exchanges, that's quite an interesting one as well. And OECD has given some guidance on what sort of, you know, how hedges should be analyzed. And finally, with respect to guarantees. Okay. The next chapter, next section of the intragroup financing guidance basically talks about the risk-free rate of return, and it actually is not going to be left as a separate chapter, whereas the rest of intragroup financing is actually left at chapter 10 of the OECD guidelines. And technically, the 2020 OECD transfer pricing guidelines should have come out by now, right? But I think it's a bit delayed. Rather, the risk-free rate of return adjustments and understanding has been put into chapter 1 of the OECD transfer pricing guidelines. Okay, so I think I covered some of this earlier as well, but I think, you know, like I was saying, the key thing around intragroup financing is around whether a particular transaction should be considered to be debt or should it be considered to be equity, right? And in relation to that, I think one of the things that, even in the model convention that was actually put out there, it says that is the rate of interest provided for in a loan contract is an arm's length rate, right? That is one part of the question. But also whether a prima facie loan can be regarded as a loan or should be regarded as some other kind of payment, in particular, a contribution to equity capital. So this was already there in our model conventions, right? But what OECD has done is taken it to the next step to say that, this is something that we first need to think about. And also, when a loan transaction is being envisaged, right? When you're trying to put together a loan transaction, you really need to think about, whether the taxpayer has the balance sheet, okay, available to take on this loan, right? And is it actually going to be a credit-worthy company, right? So if you look at all of the projections, okay, so let's assume that I go to the bank and I want to borrow money and I give them my asset and liability statements. And based on that, okay, the bank says, the maximum that I can lend to you is, say, $10 million, right? Now, if I go to my related party with exactly the same information, and then the related party is lending me $50 million, what the OECD is saying that the 10 million is going to be considered to be a loan because that is the maximum that can be absorbed in the business, and the remaining 40 million will actually be recharacterized into an equity. Okay, so again, this is actually really, really important for us to understand and review this. Okay, now let's move on to the next thing I just wanted to talk about, which is on corporate corporate tax statistics. I'm sorry, I need to go back. Okay, so this is something that the OECD introduced in July 2020, and essentially this is part of Action Plan 11, which was to collect data on and statistics on whether BEPS is actually working or not. Okay, now let's go back many years ago, because we have to go back all the way to 2012 when the BEPS initiative was actually started by the OECD. And what were the objectives of BEPS, right? And originally what they felt was that people were able to move profits from high tax jurisdictions into lower tax jurisdictions. So they were eroding the tax base in the higher tax jurisdictions by shifting profits from high tax jurisdictions into lower tax jurisdictions. And that was the basis and the synopsis of why BEPS actually came about. Okay. The second reason was that it was possible for you to split the activities between where it is being done, okay, and where profits associated with those activities were being booked, right? So value creation and profit recording or profit analysis were not going hand in hand. And the third big objective of BEPS was actually around competition, okay, and the fact that many netizens like you and I were not trusting the tax system anymore, right? So essentially what OECD has done in July 2020, they came up with the corporate tax statistics paper, where they have basically collected the CBCR information from 4,000 multinational groups, okay, which are headquartered in 26 jurisdictions and that were operating in 100 geographies, right? So it's a relatively sizable population. It is not the entire universe yet, okay, because the CBCR implementation first started off in 2016. So the first reports were actually due in 2017 based on 2016 data. And not everybody implemented CBCR at the same time, right? So if you look at, for example, in Thailand, the whole CBCR initiative has only started with respect to 2018. So different people, and even in Singapore, right? Singapore only started CBCR for 2018. So not everybody did 2016 as a first year. So essentially, we are not collecting all of the data, but we are collecting a fair number, okay, which is quite sizable. And if you look at the OECD paper, I think they said that nearly 75% of their target population, they were actually able to get information from them. Okay, so this is really, really good. But what were the key observations with respect to this paper, right? So I think the first observation was that there was a misalignment between the location where profits are being reported and where economic activities occur with the MNCs. Okay, so where are profits being booked and where is your employees, where are your tangible assets? Okay, they don't go hand in hand. As a matter of fact, the revenue per employee is higher in jurisdictions where the statutory corporate tax rate is actually 0. Okay, so revenue per employee is higher in jurisdictions where the statutory tax rates are actually 0. Okay. In addition, the share of related party revenues to total revenue is higher in investment hubs, right? So essentially what it basically says is the whole thing that we did all of this work for, that we wanted to stop BEPS, we've really not actually done that. Okay, so BEPS is still continuing. It's still quite rampant, which then brings us to the next set of slides on BEPS 2.0. Okay, now this data only came out in 2020, even though the whole initiative of what OECD was trying to fix has also been in place for a while. There are some limitations with this data. This is basically on the first year, so there might be some inconsistency in reporting and stuff like that. I think the second one is there's been additional tax reforms that have taken place. So for example, the US tax reform has actually occurred. And this is for 2016 year. So it is before the US tax reform actually took place. So that can also have another impact. Third, it's not actually possible, to identify what BEPS channel we are actually talking about, right? So where is it that we are seeing the revenue leakage coming in from? And that's something that we need to understand a bit more so we can target that particular segment of the business. Right now, we don't know. All we know is that, what we actually thought we were hoping to fix as a result of everything, we've actually not fixed so far yet. Okay. Now, having said that, let's now go on to this new initiative that OECD is working on right now, which is called BEPS 2.0. BEPS 2.0 basically says that we have a suspicion that we've not actually fixed the BEPS related issues, and therefore we think that we need to re-look at some of this again, right? Particularly, one aspect was actually not covered in the earlier BEPS initiative, which was on digital, on the digital economy. So there was supposed to be the tax challenges with respect to the digital economy, which was Action Plan 1. That was actually not addressed sufficiently, right? So BEPS 2.0 essentially started off from that Action Plan 1, but since then it has really morphed into something very, 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 very different. Okay, so this basically talks about the timeline of BEPS 2.0. I'm not going to go through all of it, but essentially the proposal that came out, okay, in 2019 was that, in May 2019, there were 3 proposals that were put forth. Okay, so BEPS 2.0 consists of 2 parts. Part 1 is called Pillar 1. Okay, Pillar 1 basically looks at the allocation of profits and new nexus rules. Okay, so essentially it's asking a question of how do I allocate profits into jurisdictions where there is no physical presence, right? And that really comes about because they are believing that it's possible to create value even though you may not actually have a dedicated subsidiary. Okay, the second part of BEPS 2.0 is Pillar 2, and Pillar 2 really talks about GLOBE, which is a minimum tax rate that is going to be set in place so that it prevents taxpayers, or it doesn't entice taxpayers to move their profits around because they think that they can save on taxes, right? Even if you were try to move it around, what GLOBE Pillar 2 basically says is that there will be an assessment that comes in later on the other side. Okay, now let's go back to the program of work. In 2019, so they came up with these 2 pillars, and under Pillar 1, they actually came up with 3 proposals, right? And the first proposal was something called user participation. So it basically says that we will try and identify how many users there are in a location, whether you have a physical presence or not, and then we will attribute profits into that user. That's number 1. The second one was on marketing intangibles, right? And this basically was put forth by the US to basically say that we need to look at your profit allocation based on where marketing intangibles are located. And the third proposal was based on significant economic presence. And this comes from India, where they were basically saying that, where do I have a significant economic presence and how is it defined? And based on that, I'm going to attribute my profits to a particular jurisdiction. Now, obviously, we had each one fighting with each other. So the user participation proposal came out from Europe, the other one came out from the US, the third one came out from India. We had everybody fighting with each other. And finally, it was decided that we will go in with one unified approach, right? And that is what the OECD is currently working on. Okay, and the unified approach basically, and it says, okay, if you look at the statement dated 31st of January, it says that they expressed a strong support for reaching the multilateral agreement with respect to Pillar 1 and Pillar 2, endorsed the outline of the architecture of a unified approach on Pillar 1 on the basis of negotiations, and they have said that they will try and reach consensus by the end of 2020. Now, obviously, this was before BEPS. Okay, and as of now, we are now in August, and there is still a lot more work that needs to be done. And I don't think that they're going to achieve this deadline. I think it is going to get pushed by a bit. And hopefully by next year, we will see a defined approach come through. Okay, but the unified approach basically looks at the profit pool and splits it up between amount A, amount B, and amount C. Okay, amount B is one that is going to really be defined by transfer pricing. That's where your benchmarks take place and so on and so forth. But amount A is in an arbitrary reallocation, right? And so there is a lot of debate around how to come up with this attribution of profits in amount A, and this is something that is still work in progress, so I'm not necessarily touching upon it here. Okay, moving on from a regional perspective, what are some of the changes that we are seeing? I think the first one is that transfer pricing documentation implementation has taken place. We're also seeing increasingly tax authorities putting out related party transaction disclosures. So the two, the main one that we are currently focusing on right now is actually Thailand. That's the hottest one for 2020. So that's where most taxpayers are focusing their attention on, because it's the first year in which you're doing transfer pricing documentation. I've also talked about these other markets where we are starting to see more traction from a transfer pricing perspective. Okay. Transfer pricing audits. There has been renewed interest in transfer pricing audit guidelines, and again, anything to do with Indonesia, I'm going to let Gandhi discuss it. So here I've come up with two markets. Both of these introduced transfer pricing audit guidelines in late 2019, so December 2019. So in Malaysia, the big one is that it increased the penalty for non-compliance from 35% to actually 50%. Okay, so that's quite sizable. So that's 50% of the tax adjustment. And Philippines, like I mentioned to you, it has, even though there is no transfer pricing rules, documentation rules, they have introduced transfer pricing audit guidelines, and they have also decided to implement Action Plan 13. Now, Action Plan 13 is really primarily around the implementation of CBCR. But, as you can see, Philippines compared to Indonesia, for example, which introduced all of this back in 2016 with PMK 213, Philippines is quite late in this game. Okay. Moving on, we are also seeing a lot of changes from an APA and MAP perspective, and a big reason for that is because of BEPS Action Plan 14, and BEPS Action Plan 14 is part of minimum standards, right? So therefore, we are seeing, a definite change or tightening and further clarifications with respect to the APA and MAP regimes, and they're taking on the guidance that BEPS Action Plan 14 has actually included. Okay. So one of the key markets that we have seen, most of the markets we've not seen a lot of noise from a transfer pricing perspective for this year. And I attribute that holistically to COVID-19. Typically, we would see things happen, but none of that is actually taking place. What we are actually but the only market that we have seen a fair amount of noise come out from is Australia. So Australia is one of the few countries that has come up with COVID-19 guidance. But it's not a lot, okay? It's a 4-pager that basically says that we are happy to consider if you might want to change your transfer prices as a result of COVID-19, we are happy to consider it, okay? They've also expanded the definition of significant global entities. So significant global entities are typically considered to be entities that are filing CBCR, but it also includes additional provisions. So that has been expanded. So where there was a very easy definition from OECD on who needs to file CBCR, the Australian local rules have expanded that definition, so more people are caught within that. So that's a thing. They've also clarified on interest-free outbound loans. Okay, now in general, when you have an outbound loan, obviously the one thing that tax authorities are consistently coming back and saying, and it's the same thing in Singapore as well, they want you to be able to support that an outbound loan is actually arm's length, which is actually quite interesting and tricky, because on what basis would you actually provide an interest-free loan? Okay, no third party in the right frame of mind would actually provide an interest-free loan, right? So how are you going to justify that? And the last one, I'm sure you guys, if you are aware of Australia, would know, is that they do have a risk framework across all of their transactions. But what they have done is they've really introduced one for distribution operations. So you've got the white zone, or you've got the yellow zone, the red zone, the green zone, so on and so forth. And they have defined, profit margins where, they will argue that as long as you're within this profit margin, you should be okay. I think that if you look at it, so for example, if you look at the pharmaceutical sector, the profit margins in the pharmaceutical sector as a distributor, you could earn as much, the range that they're talking about is 6 to 9%. Okay, whereas if you are a simple distributor, then you're looking at 1 to 4%, for example, right? And essentially what they have said is that if you fall within one of these industries and your profit margins is not consistent with what we think it should be, then you are potentially a target for an audit. Okay. Any questions so far? I think I have about 10 minutes left, but I will try. Yes?
The Q&A session actually will be at the end of the session, 30 minutes Q&A.
Okay, thank you, Jalita. Okay,
yes,
so then let's go on and let's look at the impact of COVID-19 on transfer pricing matters. Okay. In the interest of time, I don't know if I'm going to walk you through all of this, but this is where we see a lot of impact, based on our discussions with our clients, where we see that COVID-19 will have an impact on business, and related to that, to transfer pricing, right? So the first one is on liquidity, right? Obviously, COVID-19 has created constraints on liquidity, and therefore it's quite important to be able to have surplus cash or make funds available. Okay, it definitely has had a thing on operations. So you've got downtime, you've got supply chain disruptions, you've got reduced demand, difficulty to move products around. You might have already manufactured or created the inventory, and yet now you do not have access to that inventory. You can't get rid of that inventory. There's also going to be distribution channel disruptions. Okay, you can't get access to your warehouse. So all of these are issues that we are seeing from an operations perspective. From a people perspective, I think the big one is actually control, right? So if you have somebody who's doing his activities, and then he decides to move on to, he decides to go home, what happens to those activities? Would you argue that they're being done in the new location now? Would you argue that they are being done in the existing location still? So on and so forth. I think that's another big question. We also need to be able to deal with redundancy costs and productivity risks. I don't know what is happening in Indonesia. I've heard, I think you're all back to your offices. We've not gone back to office in Singapore yet, and our government's actually quite strict. Even though we've lifted off most of our safe distancing measures, like in the lifts, now you can have as many people as you want in the lift. In order for you to go into the office, you've got to fill out a lot of paperwork. And so we're working from home, and I think we will be working from home till the end of the year. I have to say that when we first started working from home, I was quite excited and happy because I thought, oh my God, I've got all this time to do stuff. And now I feel like my productivity itself has started to go down. I don't see the change in environment. I spend all my time on the computer. It's call after call after call. And I just don't see that break in my day, right? And I would love the opportunity to go to the office and come back where I can sit on an MRT and read a book or listen to music. It's difficult for me to even take the time off, right? So I think that there is definitely an impact on productivity, and maybe some people might see it as being more productive, and whereas others might see it as being less productive. Now, where we talk about all of this is really from a business perspective. There is a defined impact on transfer pricing itself, and how are we going to set our transfer prices? I think that's another question. From a legal perspective, right? Are we transacting with our related parties? In our contractual arrangements, are we having the right contractual arrangements in place such that we are transacting with our related parties in an appropriate manner, right? And how can we navigate around that? Looking at force majeure clauses and stuff like that, right? I think those are some of the things. Now let's take a quick look at some case studies. I think the first one is where you have, in a simple case, let's have a situation where Singapore is providing services to its related party. Let's assume that the related party is actually in Indonesia, and I have a situation exactly this, where my Singapore company is actually is providing environmental health and safety services, right? And so the manager actually has to travel to each of the location once a month and to do a quality audit, right? Obviously, because of COVID-19, he's not able to travel. So he does it online through Zoom or Teams or whatever. But he's not able to prevent the issues as much as he would have been able to if he was actually physically on the site. Okay, so the question now is, in relation to this service, right, how should the transfer price be modified? Is the regional headquarters not going to charge for these services because the regional headquarters believes that that there is no service that's being provided? Can the service recipient say, I'm not paying for it? Okay, regional headquarters, what is it going to do with those costs? Because then it becomes a non-deductible cost from a Singapore perspective because it has not generated any income, right? Should the cost plus arrangement still hold? What is actually there in the cost base in that case, right? There's also a big question around substance as well, right? So let's assume the regional headquarters, let's assume that it's a French company, and the senior management in Singapore is actually French, but at the start of COVID-19, they all go back to France because they are scared. So when they go back to France, and because of the time difference, right, they are less effective in providing services to Indonesia, right? Or let's take one country even worse. Let's take Australia, because the time difference will really mess it up, right? Because Australia now, if we are at noon Singapore time, Australia is at 3 p.m. or 2 p.m. France has not even woken up, right? So if the regional headquarters, okay, the managers have all gone back to France and they're trying to manage the Australian operations from there, what will end up happening is the local Australian people will start taking on more roles and responsibilities because they're not getting that support from the headquarters. So key question, what's going to happen to your substance? What's going to happen to your benefits test, right? And the bigger question, guys, is as you're going through COVID-19, are you all looking at it right now? Okay, so that's the first case study. This one is a very easy one because we all will face it. The second one is on manufacturer versus distributor. Okay, so the first question is manufacturer. Let's assume that he is located in China, and let's assume the distributor is located in Indonesia, right? We all know that COVID-19 hit China first, so China closed its borders, right? So distributor has already placed the orders with the manufacturer. Manufacturer has not delivered yet. What is the distributor going to do? Can he cancel the order? What was the transfer pricing policy in place? What was the agreed terms and conditions, right? Is it that once you place an order, you are bound to take it up, right? But obviously the distributor needs the products now because his customers are chasing him. So he then goes and buys from a third party at a higher cost, right? So how is he going to manage that? Or he buys it from another related party at a higher cost. I don't know. Okay, so how are you going to manage that kind of a situation? Now, let's go on a couple of months. Now, China has opened up, but Indonesia closed, right? Because that's exactly what happened, right? In April, the rest of the markets closed down and China decided to open up because they were over the COVID-19 period. So now the manufacturer wants to sell all his products, but the distributor cannot buy anymore. In that case, how are we going to look at it, right? Big question, how should your transfer pricing analysis and documentation change, right? In the first place, should it even change, right? It really depends on what the function, asset, and risk profile is. And this is something that we keep coming back to time and time again. If the manufacturer is considered to be a toll manufacturer, for example, then can he actually make a loss? What has happened for him to make a loss, right? So this is number 2. Let's look at case study number 3. This is on the IP transaction. I don't know if you all know, but with respect to transfer pricing, we've got 4 categories of transactions, right? So you got the tangible goods, the intangible goods, the services, and the intercompany financing. So what we've just looked at are tangible goods and services. Now we're looking at intangibles, right? So the key question is that you are giving, there are 2 ways in which you can look at it. Option number 1 is where you are selling your intellectual property to somebody else. So when you're going to sell it, you will have to do an IP valuation. What sort of assumptions did you make in that IP valuation? Are those assumptions still valid right now, right? Number 2, you may make available the right to use it on an ongoing basis through a royalty, right? And obviously a royalty is typically paid as a proportion of the sales value, right? Because your sales are down, okay, in this year, does that necessarily mean that your royalty, if your sales are down, your royalty will also have to go down? But how does that impact your valuations? Because your royalty is supposed to be a view on your valuations. So does that mean that you have an intellectual property that has a lower amount of value, right? I think that those are the questions that we need to look at from an IP perspective. And the last one is on loans. I think the first one is, as I mentioned, the OECD has just come up with this guidance. So you definitely need to be looking at it when you are thinking about these things. I think the second question is, how does the creditworthiness of the borrower change? So you might have given a loan last year, but with COVID-19, his financial projections are looking quite bad. Are you going to change his creditworthiness, and are you going to increase the cost of borrowing to him? Are you going to raise the interest rate? If so, then how are you going to be able to do it? The next question is that, does the lender have the cash to make these funds available? And if he actually does have the cash in a COVID-19 situation, should he actually be charging an extra premium for being, for having managed its operations so well that it is able to provide additional funds, right? I think that's the key question here. Okay, one of the things, just going back to BEPS 2.0 and COVID-19, as I mentioned to you, that we were supposed to have completed COVID-19 by 2020. We still have not, gotten anywhere with it. And I think there are 2 schools of thoughts here on COVID-19. Will COVID-19 dampen the impact of Pillar 1? It could, okay, from a timing perspective, as well as revenue and profitability declines, right? People may not be able to invest the amount of resources needed to come up with this sort of analysis, so they may not do it, okay? But at the same time, okay, there's also a counter view that says that COVID-19 will enhance the impact of Pillar 1, and it'll push the tax authorities to come together and, you know, enact it. And the reason for that is primarily because countries will be looking to make up for lost tax revenues, right? So they've given out all of these stimulus, right? And they want to be able to capture that back, and the only way they can do it is by rejigging their fiscal policy. Okay, so final point on the business models. I am sorry, I'm running slightly a bit behind, but I will try and wrap this up in the next 5 minutes. In terms of business models, I think there's two aspects to it. I think the first one is pre-COVID, and the next one is post-COVID, right? I think with respect to pre-COVID, it's the OECD guidelines has actually given some views on what sort of business models should be looked at. And definitely the common theme that keeps coming up is business must drive tax, not tax drives business, right? You can't do things, you can't modify your business stuff for tax reasons. It has to be the other way around. Okay, I think that's number one. I think this next one is there's been a lot more focus on the digital economy. Okay, and I think and permanent establishments, right? So when you are doing your activities, so for example, you were setting up, you know, you're undertaking a particular activity in a particular market, really think about, is that going to trigger a PE? Because the permanent establishment provisions have also expanded considerably as a result of the BEPS action plans. Okay, so what you need to do across your businesses is to understand what activities are being done in which markets and how revenue is being recognized for each of those activities. Is that being recognized in the local markets? Is that being recognized in the foreign markets? And what sort of a tax risk do you have in place, right? With respect to COVID-19, what we are seeing is there's definitely been an increase in digitalization as a result of COVID-19. I mean, that's evident from the tech stocks and the way the tech stocks are all booming upwards. Not only, you know, across, right? In order for us to survive in this space now, you need to have a digital presence, right? So there's definitely digitalization of the supply chain. And in that sense, right, there could even be a change in the value chain as well, right? So sales that were typically being made face-to-face physical has all gone online, right? So when your sales go online, what other steps do you need to take, right? Do you need to set up a server? Are you going to be using the cloud? Who manages the cloud? So there are going to be some changes. There's going to be additional roles and responsibilities that entities are going to start taking. And if all of that is correct, right, then how does your function, asset, and risk profile actually change? You can't just say that I am a simple distributor, I buy and I sell, right? Because there is an added element to it, right? And we have to identify exactly what that added element is. Okay, so for example, let's assume that we end up using a platform, right? Who developed the platform? Where did you get access to it from? Did you buy it from a third party? Is it related parties? You know, those kind of things. And I think finally the question is around, you know, now that you're going through the COVID-19 period, maybe your business has actually ended up in a loss for this year. Then the question is this the time that you want to do some sort of business restructuring and undertake some reorganization to further streamline and channel your overall business model? Okay. I think that's all I had for you. If you have any questions, I'm happy to take them now or later, depending on what Jalita and Gandhi want to do. Thank you all.
Thank you, Soumya. It was a very interesting talk. Actually, for Q&A, there will be a separate session after Gandhi session. Now, Gandhi, the time is yours. Gandhi will present about TPE new normal in Indonesia.
Sekali lagi kayak kemarin ya.
Good morning, everyone. I hope that you are all in a healthy condition. Thank you very much, Soumya, for your wonderful presentations, and also thank you very much, Jelita, for the time that you have provided for me. This moment, please allow me to briefly present the topic about transfer pricing practice in Indonesia during a new normal. So my agenda would be the background and the business trends in a new normal and its impacts to transfer pricing in Indonesia. And the third agenda is what taxpayer must do to anticipate the new normal impact. And the fourth topic will be recent development on transfer pricing regulations. We will briefly touch about the APA regulations that was issued early this year and also about digital taxes. While we are still also waiting for the localized regulations about the financial transactions, which would be in line maybe with the OECD guidelines that was issued recently. For background, in early 2020, Indonesia were hit by COVID-19 pandemic, which requires closure of business activities, example production, service, travel, restrictions, and etc. And starting in June 2020, business in Indonesia has slowly reopened and implements new normal operating procedure. This new normal requires taxpayer to adapt its business operation and also may adjust the related party arrangement. All right, so the first one is the business trends that we have observed is a lower productivity and lower revenue. This has been touched by Soumya also in her presentations. And in here we noted that a reduced productivity and lower revenue have pressured companies to manage their profitability. As we know that in the new normal era, employee attendance in office or production facilities were reduced to minimize the spread of COVID-19 virus. We noted that the reduction on attendance level varies between companies. And we also observed that there are several companies that apply attendance policy where 50% of their employee work from home and the other 50% work from the office, as it is encouraged by our local government. And this reduction of the employee attendance level may reduce the productivity and also will impact to lower revenue for the taxpayers. As such, many companies would face a pressure to manage their profitability. And the existing transfer pricing policies will be put under pressure with the economic downturn. And due to the lower profitability or loss position, the existing transfer pricing policies will be put under pressure and maybe need to be reconsidered to reflect the current business circumstances. For example, as explained in Soumya's presentation before, that in a related party transactions, when previously the pricing policy is, let's say, a cost plus percent, and by using that pricing policy, the taxpayer will still receive an arm's length profitability. However, if the same pricing policy is applied under the current conditions, then the taxpayer will also suffer a loss. So maybe this can be think by the management on how to deal with the current transfer pricing policies. And then the next one is the taxpayer will be required in the future to explain low operating profits or losses to tax authorities for the both current year and the following year. As we know that the Indonesian tax office is very sensitive to loss-making companies. especially those companies that have a significant related party transactions. That's why the taxpayer needs to prepare a financial model or a special factor adjustments to simulate the calculations of the impact from COVID-19 pandemic to its profitability. And in addition, the special factor adjustment calculation must show that the loss condition that the company suffered in 2020 is not the result of related party transactions. And the taxpayer may prepare financial model or special factor adjustment of the COVID-19 impact to demonstrate that the low profit losses were not the result of related party transactions. As I explained previously, for example, the special factor adjustment may calculate the reduction in capacity utilization because the company operations and productivity has go down, and also the company does not have enough revenue to cover their fixed costs. And also the taxpayer may also make an adjustment to extraordinary costs related to COVID-19. For example, rapid test costs or other costs that is related to the COVID-19 pandemic, which would not incur should the COVID-19 does not happen this year. And the financial model may also help in considering changes of pricing policy and other planning decisions. For example, when management considers to revise the pricing policy of a certain related party transactions, the financial model may provide a basis to estimate the impact of the revised transfer pricing arrangement to profitability. And the taxpayer, we need to gather supporting documents to prove that the impact of COVID-19 to our profitability. So for the supporting documents such as the company's policy related to COVID-19, changes in operation hours, and then changes in employee logbook, or other evidence that can prove that our business has reduced its productivity, its operating level because of the COVID-19. And if it is required later during tax audit situations, maybe these documents can be used to support our explanations or our analysis regarding the loss condition. And the second business trend that we observe during this new normal is a cash flow pressure. Businesses nowadays are experiencing cash flow and profitability issues and require short-term liquidity relief. Many companies face challenges to collect receivables from customers and also experience significant decrease in their revenue. And on top of that, the payment to suppliers and employees has come to due date, and it requires them and push the taxpayer to search for short-term financing from related parties or third parties. It can be the form of loan or other financial products. To help affiliated companies manage its cash flow, the existing related party interest transactions may be reconsidered to reduce interest burden. This can be another considerations by the team or management. And because during a difficult economic situation such this time, usually the central bank may lower the interest rate to help boost consumption and improve the economy. So this action will be further translated to lower interest rate between banks and independent borrowers. So maybe the third party intragroup, the third party loan transactions may also reflect a lower interest rate and can be used as a reference for adjusting our related party loan interest. And next one is the internal loan must be conducted in accordance with the arm's length principle. So when we want to help our group members by providing that with more loan, we must consider that the loan should be conducted under arm's length. As regulated in Per 22 in Indonesia, the intercompany loan transactions must fulfill certain criteria to be considered arm's length. First, we must have a clear reason why the loan is required or the necessity of the loan. And then we need to prove that the existence of the loan's transactions, it is actually conducted and the loan is actually provided to the subsidiaries. And according to the Indonesian thin capitalization rule, company needs to manage their debt to equity ratio of 4:1 ratio. And on top of that, then we need to test the arm's length nature of the interest rate using CAP method. We can use an external CAP method in this case. Okay, another thing that we can do is the group company may adjust their intercompany agreement and transaction flow to reduce withholding taxes and transactional tax payable. For example, based on the Indonesian income tax regulations, withholding tax for payment of service to foreign country without any treaty agreement would be 20%. As such, maybe reconsidering these transactions may help the group to save from a tax leakage and would improve their cash flow also. And the next one is the group may adjust the transfer pricing policy and allocation of profits among the groups to manage the cash flow within the groups. And then the third trend that we observe is there may be a possibility for changes in some functions, asset, and risk. As we see that some taxpayers may adjust their supply chain, for example, functions, company asset, and risk due to the disruption of COVID-19 outbreak. And the changes in the supply chain may affect the current transfer pricing group documentation. As such, the documentations must be modified to reflect the reallocation of the functions, assets, and risks. And in addition, because of the lower productivity due to the COVID-19, we also see that there is a trend where increase of employee layoff in Indonesia. And this may also impact the function, asset, and risk profile of a business. For example, like if a taxpayer in Indonesia who they may consider, for example, to close their finance, accounting, and tax department and centralize these functions to a certain entity within the group, they may need to also update their transfer pricing documentations to reflect these conditions. The fourth trend that we observe is business migrates to online. As we know that because of travel restrictions and because of the COVID-19, more people are doing activities at home. They less go outside. So more customer buy from online channel. The customers' purchase behavior has shifted from offline to online channel. As such, maybe some taxpayers would want to adjust their business operations to according with the customer's purchase behavior. And then the next one is there are less business travel may impact intragroup service arrangement. Currently, there are less business travel as most employees work from home because of the travel restrictions. This condition may affect the intragroup service since some of the activities will be migrated to online. Example, the service is provided via Zoom, or maybe the meeting will be conducted virtually via online. As previously, most of the meetings most of the service are provided offline. As such, the previous related party service arrangement that were delivered offline may require certain modifications. And this is the fifth trend that we have observed. We noticed that currently the tax auditors are becoming more aggressive in the new normal. We see that there is an increase of tax audits for taxpayers, even though they are not overpayment, even though they are in underpayment position, they still receive tax audit instruction letters. This we have noticed. And the other thing is we also noticed the increase of information requests from account representative to the taxpayers. This behavior of the tax auditors becoming more aggressive due to the various reasons. The first reason is because of the increase of government expenditures to handle the COVID-19 pandemic. So recently, our president has just issued the presidential decree number 72 in year 2020, and the government has set a budget of 693 trillion rupiah in response to COVID-19 pandemic. However, the budget amount is greater than the actual tax revenue for our first semester in 2020, which is 625 trillion rupiah. And the other one is the increase of government program or subsidies to anticipate the COVID-19 impact. So to minimize the COVID-19 impact, the government has also provided incentive to Indonesia citizens, such as program Keluarga Harapan, and then program Kartu Sembako, program Kartu Prakerja. So we see the trend that the government are spending a lot due to this COVID-19. And this spending needs to be financed from the tax revenue. That is why the reason the tax officer are growing to become more aggressive to be able to secure the tax revenue to finance all of these COVID-19 related expenses by the government. And for information, we see here the comparison between the tax revenue target and tax revenue realization in semester 1 for 2019 and 2020. As we can see, in 2020, the tax revenue realizations is highlighted in the red color, 625 trillion IDR, and in 2019 is 690 trillion IDR. This is reduced almost 10% lower than 2019. That is why they need also to boost their productivity to achieve the tax revenue, and it gives more pressure to the tax auditor team nowadays. Okay, for our third agenda, we'll touch about what taxpayer must do to anticipate the new normal impact. So the first one, of course, we need to have an ongoing documentations of our economic factors. The financial impact that was experienced by all of us today, the taxpayers, is a result of COVID-19, is a valid reason for lost profitability, and also independent companies can also experience loss due to COVID-19. That's why taxpayers, we are advised to prepare all the supporting documents concerning the COVID-19 impact on the company's overall operations, so we can use it as an evidence when we were challenged by the tax office in the future. And then the second one that we can consider is the ex ante versus the ex post analysis. The ex ante analysis is an approach where the taxpayer proves that they have made efforts to follow arm's length principle at the time of the related party transactions, while the ex post analysis is an approach where the taxpayer examines the actual results of related party transactions to prove the arm's length principle. And in the ex post analysis, it will be difficult to apply at this time because the comparison company financial data for 2020 tax year will not be available at the time of the analysis is conducted. Therefore, another alternative, by conducting an ex ante analysis, the taxpayer can prove that the transfer price set at the beginning of the year or the company's budget for 2020 is determined based on the arm's length principle. So the deviation from the arm's length principle that occurred in 2020 was a result of the COVID-19 outbreak. And the third one is, we can try to consider for postponement of payment and funding tempo with related party. As independent supplier, sometimes they can provide their customers with payment delays to assist in cash flow management. Likewise, related party companies can also provide deferred payments facilities to assist in cash flow management. Group companies also may help to predict future cash flow to determine the methods that can be used to effectively support the cash flow of their subsidiaries. And also, there can be increased loans from related party to manage the working capital required by the subsidiary. And the fourth thing that we can think of is the renegotiation of related party agreements. Because the related party transactions or prices are set based on normal economic conditions in the previous year. And maybe now, taxpayer may consider whether the price or the margin is still valid in the current economic situations amid the COVID-19 outbreak. Okay, now I will touch a little bit about the recent development on the transfer pricing regulations in Indonesia. So there are two regulations that we will just briefly discuss here for your update. Is the Ministry of Finance Regulations number 22 regarding advanced pricing agreement, and the Ministry of Finance Regulations number 48 regarding the procedures for appointing the VAT collectors of services or intangible goods from outside Indonesia traded through the electronic system. So this is the update of the VAT of regulations number 48, where the subject of these regulations is offshore trader and offshore service provider. And the object are intangible goods such as computer software, virtual goods, electronic data, virtual coin, movie streaming, music streaming, and etc. And also services such as web hosting, video conferencing, hosting, and other software-based service where the products are provided, or the service and the product are provided through an electronic media. And the rate for the VAT is 10% from the tax base and will be collected upon payment from customers or service recipient. So the government has selected appointed six companies as a VAT collector. They are Amazon Web Services, and then Google Asia Pacific, and Google Ireland, and Google LLC, and also Netflix International for movie streaming, and Spotify AB for the music streaming. So these are the companies that are appointed to collect the VAT, and these companies would store the VAT to the government and also would make a VAT report, would submit the VAT report to the government periodically. And at this session, I will touch a little bit about the regulations number 22 regarding the advanced pricing agreement. So I have compared in here the APA regulations in 2015, you can see in the middle, and the APA regulations in 2020, you can see in the right side. So for the formal applications in the previous APA regulation, that taxpayer need to submit supporting documents 2 times. First, they need to submit a pre-lodgement, and then after that, they will submit the applications. But in the updated APA regulations, taxpayer only need to submit the APA applications to the tax office, and taxpayer does not have to submit any supporting documents with the application form. And then the next difference is in the initial discussions. In the previous APA, the taxpayer have to conduct initial discussions with DGT before submitting the APA applications. But in the recent regulation, we do not need to conduct initial discussions. And then the next difference is in the rollback. Previously, there is no rollback, but in the 2020 APA regulations, rollback is allowed for the previous year prior APA period. And for the previous APA, the period is for 3 years for unilateral APA and 4 years for bilateral APA, while in the recent regulations, we have a maximum of 5 years for all type of APA for the APA period. And next, the difference is in the discussion period. For the 2015 APA regulations, the discussions is carried out within a period of no later than 1 year after the APA application is received and can be extended for maximum of 1 year. And in the recent update, that the discussions will begin no later than 6 months. after the taxpayer submits the complete APA application and shall finish in maximum of 12 months. So the recent APA will have a shorter period, more fast period for discussions. And the next difference is about the APA renewal. In the 2015, APA renewal is treated the same as the new APA submissions, but in 2020 regulations, taxpayer only needs to submit a request for APA renewal without the need to repeat the flow of the APA submissions process. Okay, so as a conclusions, the COVID-19 outbreak could have a significant impact on the taxpayers' current business, and even the COVID-19 will continue to be felt even though the COVID-19 outbreak has ended. And as a taxpayer, we may consider to prepare our documentations and also our approach in the analysis, and we may consider to renegotiate terms and the conditions of related party agreements, such as pricing policy or terms of payment, to help us during this COVID-19 situations. Okay, thank you for attending our presentations, and we hope that my session will be useful to help you manage your transfer pricing matters. And if you need our help or you have any questions, I'm happy to have it. Or you may contact us later via email or our website here. Okay, I'll give it back to you, Jelita. Thank you for the time.
Yes, thank you, Gandhi. Thank you, Soumya and Gandhi, for all the answers. That was a very insightful discussion. I think there will be no more question and answer session. This is the end of the Q&A session. And ladies and gentlemen, may I thank you very much for your active participation in this event. I hope you enjoy the program. Please follow our social media to see the update schedule of our future events, and don't forget to fill the CFF because the material and e-certification will be given upon the CFF submission. Okay, good day and goodbye. Thank you.
Thank you. Thank you.